Welcome to Solidarity Spotlight, the place where we share with you bleeding-edge stories. I'm your host, Solidarity. Let's discover what's happening today in blockchain. The cryptocurrency markets experienced a seismic shift today as Bitcoin shattered through the psychological $114,000 barrier, marking one of the most significant price movements of 2025. This explosive rally coincided with dovish expectations from the Federal Reserve, as investors position themselves ahead of anticipated rate cuts that could inject additional liquidity into risk assets. The breakthrough past $114,000 represents not just a technical victory for Bitcoin bulls, but a fundamental shift in market sentiment that has been building throughout September. Market analysts are pointing to the convergence of multiple bullish catalysts, including improved regulatory clarity and unprecedented institutional adoption, as driving forces behind this remarkable surge. Adding fuel to the fire, today witnessed the historic launch of the first United States Dogecoin exchange-traded fund, marking a watershed moment for meme coin legitimacy in traditional finance. The Doge ETF represents a paradigm shift that extends far beyond Dogecoin itself, signaling that regulators and institutional gatekeepers are increasingly willing to embrace cryptocurrencies that were once dismissed as jokes or speculative bubbles. This development could trigger a domino effect across the broader altcoin ecosystem, as other meme coins and alternative cryptocurrencies may now have a clearer pathway to ETF approval. The market implications are staggering, as ETF launches historically provide institutional-grade access that can dramatically increase trading volumes and price stability. The regulatory landscape underwent a dramatic transformation with the Securities and Exchange Commission's announcement of Project Crypto, a comprehensive framework that promises to bring unprecedented clarity to the digital asset space. SEC Chair Paul Atkins revealed to the OECD Global Financial Markets Roundtable that new rules will clarify that most crypto tokens are not securities, allowing trading, lending, and staking under a unified framework coordinated with international regulators. This represents a complete reversal from previous regulatory hostility and could unlock trillions of dollars in previously sidelined institutional capital. The Commodity Futures Trading Commission simultaneously opened foreign exchange access through new guidance, allowing non-US venues listing digital asset derivatives to register as foreign boards of trade, effectively removing major barriers to onshoring liquidity. BlackRock, the world's largest asset manager, made waves today with massive cryptocurrency movements totaling approximately $297 million. The firm transferred $195 million worth of Ethereum and $101 million in Bitcoin to Coinbase Prime, sparking intense speculation about institutional crypto strategies. These movements occurred amid heavy redemptions in BlackRock's Ethereum ETFs, with outflows reaching $912 million in a single day, while Bitcoin ETFs experienced $524 million in inflows. This divergence between Bitcoin and Ethereum institutional sentiment could signal a broader rotation within crypto portfolios, potentially driven by Ethereum's scaling challenges and regulatory uncertainties compared to Bitcoin's increasingly clear regulatory status. The September token unlock tsunami reached its peak today, with projects releasing approximately $4.5 billion worth of previously locked tokens into circulation. Leading this massive supply event, Sui unlocked $189 million worth of tokens, followed by Athena's $61 million release, and significant unlocks from Aptos, Arbitrum, and other major protocols. This represents one of the largest monthly token unlock events in cryptocurrency history, and could create substantial selling pressure across multiple projects simultaneously. However, the market's resilience in the face of these unlocks, particularly Bitcoin's surge past $114, suggests that demand may be strong enough to absorb the additional supply without triggering a broader correction. Linea, the Ethereum Layer 2 network developed by Consensus, experienced a dramatic launch today that immediately turned sour, as its native token crashed over 33% in the first hours of trading. The long-awaited Linea token, which launched through a token generation event with an initial circulation of 15.8 billion tokens, saw whales rushing to sell their holdings despite listings on major exchanges like OKX and KuCoin. This crash occurred on the same day that Linea briefly stopped producing blocks due to problems with its centralized sequencer. highlighting the ongoing technical challenges facing even well-funded Layer 2 solutions. The market reaction underscores the continued volatility and execution risk inherent in new token launches, even for projects with strong technical foundations and institutional backing. The battle for Hyperliquid's native stablecoin ticker, USDH, intensified today as major players including Ethena, Paxos, Sky, and other established stablecoin issuers submitted increasingly competitive proposals. This unprecedented governance auction for stablecoin issuance rights represents a paradigm shift in how decentralized exchanges approach monetary sovereignty. With over $5.5 billion in USDC currently powering Hyperliquid, and approximately $220 million in annual yield flowing externally to Circle and Coinbase, the USDH decision could redirect massive value streams back to the protocol and its users. The competitive bidding process has forced stablecoin giants to offer unprecedented revenue-sharing arrangements, with some proposals promising to return 95% of generated yield to the Hyperliquid ecosystem. JP Morgan released a comprehensive analysis today confirming that institutional cryptocurrency adoption remains in early phases despite growing momentum across multiple metrics. The Wall Street banking giant reported that institutions currently hold approximately 25% of Bitcoin exchange-traded products, while the Chicago Mercantile Exchange recorded record-high institutional open interest in cryptocurrency derivatives. An EY survey revealed that 85% of companies have already allocated to digital assets or plan to do so by 2025, with regulatory clarity cited as a key driver behind allocation decisions. This institutional validation comes as traditional finance infrastructure increasingly integrates blockchain technology, with JP Morgan's own Connexus blockchain network processing over $1.5 trillion in transaction volume since inception. Enterprise blockchain adoption accelerated today, with several major announcements highlighting the technology's growing maturity in traditional business applications. JP Morgan's Connexus platform secured mandates from Qatar National Bank and Saudi National Bank, solidifying its position as a leading blockchain infrastructure provider for major financial institutions across the Middle East and North Africa region. These deployments enable 24/7 settlement of corporate flows and programmable cross-border payments, demonstrating blockchain's practical utility beyond speculative trading. The enterprise adoption trend extends to other sectors, with Toyota partnering with Avalanche on a blockchain-based mobility network, and Trimont LLC piloting blockchain loan payment automation, suggesting that institutional blockchain use cases are finally reaching critical mass. The regulatory countdown intensified today as the European Union's markets in crypto assets regulation approaches key compliance deadlines. MiCA compliance requirements for crypto asset service providers fall between December 30th, 2025 and June 30th, 2026, depending on jurisdiction, while other businesses must already adhere to the comprehensive regulatory framework. The approaching deadlines are forcing cryptocurrency businesses to invest heavily in compliance infrastructure, potentially creating competitive advantages for larger, well-capitalized firms while squeezing smaller operators. The regulatory clarity provided by MiCA, while initially costly to implement, could ultimately legitimize the cryptocurrency industry across the European Union's massive economic bloc. Bitcoin Hyper, a Layer 2 solution built on the Solana virtual machine, announced today that its presale has surpassed $15 million, positioning itself as one of 2025's most successful cryptocurrency fundraising efforts. The project promises to address Bitcoin's scalability limitations by enabling near-instant transactions, low fees, and full programmability, while maintaining Bitcoin's legendary security through its canonical bridge technology. The success of Bitcoin Hyper's presale reflects growing investor appetite for Bitcoin scaling solutions, particularly as the base layer cryptocurrency reaches new all-time highs and transaction fees become increasingly prohibitive for everyday use. The convergence of these developments creates a complex and rapidly evolving landscape for cryptocurrency markets. The combination of regulatory clarity, institutional adoption, technological advancement, and massive capital movements suggests that the industry is entering a new phase of maturation. However, the simultaneous occurrence of major token unlocks New project launches and regulatory deadlines also introduces significant volatility and execution risk across multiple market segments. The market's ability to absorb the $4.5 billion token unlock event, while Bitcoin surges to new highs, demonstrates remarkable resilience and suggests that demand fundamentals may be stronger than many analysts anticipated. The institutional validation provided by ETF launches, regulatory framework announcements, and enterprise blockchain adoption creates a positive feedback loop that could sustain momentum even in the face of typical selling pressure from unlock events. That, the competitive dynamics around stablecoin issuance, exemplified by the hyperliquid USDH auction, highlight how decentralized protocols are increasingly asserting monetary sovereignty and seeking to capture value that previously flowed to centralized stablecoin issuers. This trend could reshape the stablecoin landscape significantly, particularly as protocols with substantial trading volumes and user bases realize they can internalize the economic benefits of their monetary infrastructure. The enterprise blockchain adoption announcements, while perhaps less exciting than speculative price movements, represent the foundational infrastructure development that could drive long-term, sustainable growth in the blockchain industry. Major financial institutions and corporations are no longer experimenting with blockchain technology, but are deploying it at scale for mission-critical business processes, suggesting that the technology has finally achieved the reliability and performance characteristics necessary for widespread enterprise adoption. That concludes today's Blockchain Spotlight. I would love to know your thoughts. Thanks for listening, and don't forget to follow me for more spotlights. See you next time.